Welcome to the Money Metals Midweek Memo, news and commentary relating to sound money, the precious metals markets, and the economy. I'm your host, Mike Maharrey. Thanks for tuning in. So, it's important not to confuse a symptom with the illness. That's because a symptom can stem from a lot of different causes, right? Some of them minor, some of them may be life-threatening. For instance, let's say you have chest pain. Well, could be just heartburn. Or you could be having a heart attack. So if you just pop some antacids, hoping to alleviate that symptom and move on, when you're actually having a cardiac event, well, you could end up dead. That symptom is just telling you, hey, dude, pay attention, check this out, find out the root cause, right? Find out what's going on and treat the illness. You can't just treat the symptom. And I think this analogy kind of works over into the financial markets, right? Moves up or down can be caused by a lot of different things. And to really grasp what's going on, we have to try to drill down and understand the fundamentals behind price movements. Now, that's not always easy to do because, again, in the economy, there are a lot of different factors, but it is very important to try to isolate and figure out exactly what's going on behind the scenes. So right now, we see gold and silver going up at a mind-boggling pace. Think about this. Last Friday, gold corrected, and it fell below $4,000 an ounce. And this wasn't surprising. I kind of expected it. But Monday morning, it was back above $4,000. So it seems that $4,000 is establishing itself as support already. And when I got to my desk this morning, gold was up another $40+ overnight. And trading at just over $4,200 an ounce. December gold futures were at $4,235 an ounce. Now, a lot of the same factors that have been driving gold higher for the last several weeks are in play right now. We've got this government shutdown that's driving some safe haven buying, and we've got some increased trade tensions with China that tends to ebb and flow. But really, this is the continuation of a gold bull market that has been ongoing for well over 18 months now. And so we can't just look at these daily events and chalk up all of the price movements to those. We need to look a little bit deeper. Now, Federal Reserve Chairman Jerome Powell, yesterday, he fed the precious metals bulls when he all but guaranteed another rate cut later this month. And, if you just if you're not really paying real close attention, it's kind of mind-boggling that the Fed is cutting aggressively right now, given that we are clearly still in an inflationary environment. And so, why would you cut interest rates? Well, it's less mind-boggling when you realize how much debt there is in the economy. We have a debt-riddled bubble economy that simply cannot function in even a normal interest rate environment. So therefore, we're going to choose the economy over inflation is basically what the central bank is doing. So we're seeing this big move up in gold. And of course, it's not just gold. I think the rally in silver over the last week or so is even more impressive. Silver was at $52.83 when I got to my desk this morning, knocking on the door of $53 an ounce. And that's just it's been a huge move up in the silver market. And, again, it's kind of mind-boggling. It's kind of wild watching the mainstream banks right now. They're having to revise their forecast because gold has already blown through them. Goldman Sachs recently upped its 2026 price projection to $4,900 an ounce. And not to be outdone, Bank of America has now raised its 2026 forecast to $5,000 an ounce. Now think about that. A couple of years ago, talking about $5,000 gold, that was fringe, right? Now it's mainstream thinking, A mining CEO named Randy Smallwood told Bloomberg TV that the Bank of America forecast was more than reasonable, and that might just be the beginning. He said, I'm confident that we will see gold over $5,000 within the next year. It's a trajectory that could easily put it up to $10,000 an ounce before the end of the decade. So we're talking 2030. He said, I wouldn't be surprised at all. Now, $10,000 gold may sound like, wishful thinking of some gold bug or maybe some fringe conspiracy stuff, but, that's what they were saying about $5,000 gold just a few years ago. Now, keep in mind, as we go through this process together, we're going to see corrections. Markets don't go up in a straight line. And right now, in my opinion, down days are buying opportunities. For instance, if you bought gold last Friday when it dipped below 4,000, you're looking pretty good right now. But again, we're going to see those corrections. We may even see big corrections. It's important not to panic. You don't want to get too high or too low as the price moves on a daily basis. And I think there's a lot of nervousness right now in the silver market, right? Because every time silver has gotten to this record level, and it's done it twice, it's dropped way back down. And I was reading an analyst earlier this morning, and he was talking about, that the fundamentals are great in the silver market, but I'm really worried because we've seen these deep dives after we've hit records before, and the charts don't lie. Of course, he ignored the fact that this is a classic cup and handle technical chart, and it's a secular cup and handle, and we just broke out of the handle, and historically that has been a major upside after that breakout. So you can look at those technicals in different ways, but anyway, we've seen these massive moves higher in both gold and silver. What is this telling us? What is this a symptom of? What is behind this relentless bull market? We see the prices rising, that's the symptom, but what is the underlying cause driving it? Now, a lot of people are pointing to the decline of the dollar, and they're absolutely right. That's at least part of the story. The rise in the price of gold reflects the depreciation of the dollar. Smallwood made this point saying, quote, "It's the measuring stick that we're using. It's the US dollar that we're all seeing, that we're all concerned about in terms of long-term strength." So, as the dollar weakens, the price of gold is going to go up in dollars. But when people use the dollar index to make this point, and the dollar index has dropped significantly this year, we've seen a lot of dollar weakness, but when you point to that index to make this point about gold, and I'll be honest, I've been guilty of this, we're missing the bigger picture. It's not just about the dollar. Gold is setting records in every major currency. The dollar index just tells you how the dollar is faring against other fiat currencies, right? It compares dollars to yuan or yen or euros, etc. It's not telling us anything about how the dollar compares to gold. You just have to look at the price of gold to understand that. And really what this is pointing to is a breakdown of the broader global fiat system. It's not just dollars that are depreciating rapidly. All of these major fiat currencies are. Real money, gold and silver, are showing their mettle right now. And yes, that pun was intended. Then there's another factor that the precious metals markets are responding to, and this is most evident with silver. And I'm going to dig into that here in a minute because I think it's extremely important. We're going to tell the story of silver's recent bull run. But first, I want to thank you for listening to the show. I really do appreciate it. I say this every week, but I know that there are a lot of things that you could listen to, a lot of choices out there. I thank you for spending time with me. And if you would do me a huge favor, it would really help grow the show. Just go to wherever you listen and leave a review. Leave a good, strong review. Give us those 5 stars. Crush those like buttons when you see the episodes. Share these episodes around. Help us to grow the listeners. If you like the show, I'm sure other people will too. So if you would do that, it would really mean a lot to me, and I would say thank you. And I do thank you because I know there are folks out there that are doing that, so I appreciate it. So let's talk about silver. The price has risen astronomically, right? The wild thing is that based on the technicals, there's still plenty of upside remaining. Silver just broke out from a classic cup and handle pattern, as I just mentioned. And historically, this signals the beginning of a breakout, right? Not the end. So we may well be just getting started. That means there is likely still time for you to get in on action. Meanwhile, the gold-silver ratio is hovering around 80-1 still. And I've talked about this before. I talk about this ratio a lot. It tells you that silver is still underpriced compared to gold. The average in the modern era has been around 60-1. So when the ratio gets really wide like this, it typically snaps back to the mean relatively quickly, often in the later stages of a gold bull market. Now, quite frankly, given the underlying dynamics, the debt, the de-dollarization, the inflationary environment, I don't think this bull market in gold is anywhere near the later stages. So we may see a lot of upside with both metals. Now, if you're interested in getting some silver, consider getting random silver rounds or junk silver. And Money Metals has discounted some of these items substantially. Now, I talked about junk silver in the show last week. These are quarters, dimes, half dollars that were minted prior to 1965. They're 90% silver, and I haven't looked at the melt value today, but last week it was just below $9 for a silver quarter. And so we've got really low premiums on those right now. We also have some nice discounts on random silver rounds. So we pick the design of the round and you get a good deal on silver. So check those out. I'll put some links in the show notes page. If you're interested, I don't think it's too late to get in on this silver bull market. So let's look at the dynamics in the silver market right now. The price has soared partly due to a massive short squeeze and a shortage of available silver in London. Now, as you'll see as I walk you through this, a metal shortage is the key to understanding what's going on with silver and why the price is rising and why there's actually right now some panic in the marketplace. And while it's less pronounced in the gold market right now because the gold market is so much bigger, there's some similar dynamics in play, I think. So what do we mean by a short squeeze? Well, in simple terms, a short occurs when somebody sells a silver contract today, committing to deliver silver at a set price in the future with the expectation of a falling market price. So they position themselves with a short. If the price drops, as they expect, the investor can sell that contract and pocket the gain. But the risk is if that price rises, then the investor's going to suffer a loss. And if nobody will buy back the contract, he's obligated to deliver that silver. So when prices rapidly rise, as they have the last week or so, the folks who are in short positions, they get squeezed and they have to scramble to try to cover those shorts. And this can create kind of a feedback loop that drives prices even higher, causing more of a squeeze. And you can kind of see how this just goes. It goes up and up and up. And we're in a squeeze situation right now, and this has caused liquidity in the London market to virtually dry up. The London benchmark price has gone higher even more rapidly than the overall spot price, and it's caused a price gap between New York and London. The London spot price recently shot to a $3 premium over New York futures. So there's an arbitrage opportunity here. There's an opportunity to make money if you can move silver between those two markets. The last time we saw a premium like this was during the Hunt Brothers squeeze back in the 1980s. Meanwhile, the cost to borrow silver overnight rose to well over 100% on an annualized basis. And this just reiterates the fact that there is a shortage of metal. In another sign of market stress, the bid-ask spread for London silver exploded from its typical level of around 3 cents to well over 20 cents per ounce. And a JP Morgan Chase managing director, or he's a former managing director, he said, quote, "Banks don't want to quote each other, so the quotes get extremely wide. That's creating this tremendous illiquidity." Now, according to Bloomberg, the squeeze is so dramatic that some traders have booked cargo ships to transport silver from New York to London to take advantage of this London price premium. This is really unusual because we normally only see this in the gold market, right? Silver is much bulkier and it's a lot more expensive to move. So you have to have a serious opportunity in order to go to all the trouble to actually physically move all of this silver. An investment company CIO told Bloomberg that he's never seen anything like it. He said, quote, "What we're seeing in silver is entirely unprecedented. There is no liquidity available currently." But this isn't just about some investors getting hung up in a bad position, right? Looking at the Indian silver market provides a little bit more clarity on what's happening in the bigger picture. In fact, India could be the straw that broke the silver camel's back. Now, most people associate India with gold, but the country also ranks as the world's top silver consumer. And as I said, one of the reasons for silver's surge to record levels in recent days is this shortage of available metal in London. And it's being partly driven by voracious demand in India. Now, here's the thing. India's silver market reveals deep structural problems indicative in the broader global market. And simply put, there isn't enough actual silver. And the risk of a major blowup is mounting. So demand for silver in India began to surge earlier this year after the white metal zoomed to new all-time highs in rupee terms. Remember, I said this isn't just about dollars. It's about an entire fiat system that is getting shaky. So silver was at record levels in rupees months ago. With growing investor interest in silver during an environment when gold seemed very pricey, a silver supply shortfall in India also sent the price to a significant premium locally. And supply simply can't keep up with this demand. Indian silver imports exploded in January and February, but they fell off as the year progressed. According to Reuters, imports were down about 42% from the same period in 2024 through the first 8 months of the year. So rising demand in recent weeks soaked up the surplus imported last year that now needs to be met through additional imports today. Initially, Indian investors were primarily sourcing silver from Hong Kong, but they reportedly shifted more toward London during the Chinese Golden Week holiday during the first week of October. And this has exacerbated the silver shortage in London. Now, much of the silver that is stored in London vaults is already committed. A lot of it is committed to ETFs. So that leaves very little, quote, free float metal to provide liquidity to the London market. According to Bloomberg, the amount of free float silver has dropped from a high of 850 million ounces to just 200 million ounces. That's a 75% decline. And a couple of analysts that I've read say that actually this is understating the severity of the drop. Large silver shipments to the U.S. earlier this year, when we were having all of the worries about tariffs, has actually exacerbated this situation. It drained metal from London vaults. Now, Indian traders are trying to get their hands on metal wherever they can. At least one major silver fund in India completely halted the acceptance of new investors, citing a lack of metal. However, there are still investment vehicles in India that are accepting new funds, so this raises worries that they might not be able to source the necessary silver. And to kind of tell you just how significant this is, Money Metals Exchange just arranged for a large shipment of 1,000-ounce silver bars from the U.S. destined for India via Dubai. Money Metals CEO Stephen Gleason said, "We might be doing this daily for a while." Bullion banks are engaged in similar operations, standing for delivery of silver on the COMEX and airlifting silver bars to Europe and beyond. According to an article in BW Business World, which is an Indian financial publication, demand for silver in that country is, quote, frenetic. It said shelves are empty, mints are running overtime. However, there's an unusual anomaly in the Indian market right now, and this is important. MCX futures, so that's the Indian equivalent of the COMEX, they're trading by as much as 20,000 rupees per kilogram below the street price. So we've got a situation where futures are trading below that street price. Business World said this isn't a, quote, small kink. Quote, it's a gaping hole in India's precious metals markets, and it's getting wider, unquote. A commodity strategist who requested anonymity told Business World, quote, this isn't a normal backwardation. This is a market stress. It's a signal that someone, somewhere, can't deliver metal. And therein lies the rub. There simply isn't enough silver to meet the surging demand. And it's not just an India problem. The global silver market is on track for its fifth straight structural market supply deficit. Global demand outstripped the silver supply for the fourth consecutive year in 2024. That structural market deficit was 148.9 million ounces, and that drove the four-year market shortfall to 678 million ounces. That's the equivalent of 10 months of mining supply based on the mine production in 2024. And of course, the Silver Institute projects a fifth straight supply deficit this year. So we're entering our fifth year, or actually nearing the end of our fifth year, where mine output has not kept up with above ground demand. And when miners can't produce enough metal to meet that demand, well, people who need the metal have to source the silver from existing above ground stocks, like silver bars that are sitting in the vaults at Money Metals. But to entice people to let that silver go and to flow into the open market, the price has to rise. So you kind of can see where we are right now. Now, last year, there was record industrial demand for silver, but investment demand was actually tepid. But as the price has neared record levels this year, of course, investment demand has surged, and that has stressed the market close to the breaking point. As Business World put it, quote, globally, silver inventories are collapsing. Quote, borrowing costs for the metal in London have spiked to multi-decade highs. ETFs and industrial consumers, from solar manufacturers to electronics firms, have swallowed up available stock. Refiners in Canada, Australia, and even Vietnam are reporting backlogs. Business World reports that the silver shortage has turned the physical silver market in India into a, quote, feeding frenzy. And this chaos is bleeding over into the Indian futures markets. Silver stocks in the MCX vaults are getting thin. Quote, even if a fraction of contract holders demand delivery, there isn't enough metal, a bullion trader told Business World. That right there, ladies and gentlemen, this is the key. Like, this is the main point of this show today. There isn't enough metal. We've got all of these paper contracts and all of these futures, and there's simply not enough physical silver to meet all of the demand. Business World explained that trading physical silver for futures contracts looks like a no-brainer on paper, but it is an arbitrage few will touch. I mentioned arbitrage again. Arbitrage is the practice of buying and selling an asset simultaneously in different markets. So it's the same asset, but in two different markets to profit from a temporary price difference. So you've got silver more expensive in London. It's cheaper in other places. So that's an arbitrage opportunity. Now, as I've already mentioned, the price for physical metal is way above a futures contract right now. So a trader could sell silver at that higher price, sell physical silver, and then buy futures at a lower price, take delivery of the metal in that futures contract on December 5th, and pocket a huge profit, up to 24,000 rupees per kilogram. So who could resist, right? Well, right now, almost everybody can resist. A trader quoted by Business World explained exactly why. Quote, who will trust delivery in this environment? Even if you have cash and contracts, you can't be sure you'll get the metal. So to put that another way, even if you have paper, that doesn't mean you can get the metal. You know, anytime I write about ETFs, I mention the fact kind of as a passing note that owning an ETF is not the same as owning physical metal. You own paper with a promise to deliver metal or a promise that metal exists, right? That's not actually having metal. And right now, when you have that paper, you certainly can't be sure that you've got the metal. Now, this situation right now is most acute in India, and that's why we're talking about India. However, it is indicative of the global market, and it explains why prices have risen so quickly. And that brings us back to London. There's really only one way to relieve this pressure, and that's make more silver available. And this can only happen if ETFs sell, freeing up that metal for the free float stock, or by physically moving new silver to London from overseas. Both of those mean higher prices. An executive at a logistics company said he has received calls from customers seeking to take silver out of New York COMEX vaults and move it to London. He estimates traders want to shift between, get this, 15 and 30 million ounces of metal between these two hubs. That's over 2 million pounds of silver. A spokesperson for a precious metals refiner told Bloomberg, quote, there will be a natural momentum for material to move back into London, and hopefully things will normalize. It's just a question of mobilizing those balances that are sitting elsewhere in the world and moving them back to London. Now, it sounds simple, right? But it's not. In the first place, it's going to require higher prices to clear the market. Furthermore, according to Bloomberg, some traders are reluctant to move metal from New York to London. Quote, the logistics are complicated, particularly amid fears the government shutdown may slow down customs processes, and the London squeeze means that even 1 day's delay could be punishingly expensive. And as prices rise, the situation is going to snowball. Like I said, this is a feedback loop. It just kind of ratchets up and up and up. So we could see easing pressure in the upcoming weeks. In fact, we probably will see some easing pressure in upcoming weeks as the metal moves to areas of higher demand. But there's still no easy fix for the underlying problem, right? There's a lot of demand for silver globally, both industrial and investment, and there simply isn't a lot of silver to meet that demand. And again, it's not just about India. Money Metals CEO Stephen Gleason, he summed it up very well. He said, quote, maybe India is the straw that has finally broken the silver camel's back. Given India demand was heavily skewed to gold, just a small switch to silver can make a big difference in a small physical market dominated by leverage. So the bottom line is, the situation's not going to fundamentally change anytime soon, right? We may get some metal to London, and that may ease some of that situation. But unless something very unexpected happens, this upward price pressure is likely going to dominate in the near to midterm. And that means there's still plenty of upside for silver. So that means you want to have silver, right? And I don't think it's too late to get in on this bull market. I don't even think it's too late to get in on the gold bull market. Quite frankly, I think that, again, these dips that we're seeing are simply buying opportunities, because the bottom line, when we look at both gold and silver, one of the fundamentals that's pushing precious metals in general up is this breakdown of the fiat money system. It's money printing, it's inflation, it's the devaluation of the currency. And as this fake paper money depreciates, then gold and silver, real money, are going to continue to increase in price, because it's just a kind of a relative comparison between these two types of money. So you want to have real money. You want to have gold and silver. Today's a great day to call a Money Metals, precious metals specialist, 800-800-1865, and have a chat with them. They'll help you understand what's going on with the precious metals markets. They'll help you figure out how gold and silver can fit into your investing strategy. I mentioned last week that, a very prominent JP Morgan investor, was talking about the fact that we need to start looking at a 60-20-20 portfolio with 20% allocated to gold. Now's the time to get into doing that. So give them a call today. These folks are great. They'll answer your questions. They can help you out. If you don't want to talk on the phone, you can go to moneymetals.com, chat with the precious metals specialist right online. Or if you don't need to do any kind of talking, you just want to order gold and silver, you can go to moneymetals.com and pick out what you want. We'll ship it to you, or we can store it in our state-of-the-art bullion facility in Eagle, Idaho. But do it today. It's not too late, but sometime it will be, right? So that is a wrap for this episode of the Money Metals Midweek Memo. You can get more information about everything that I've talked about on the show today and a whole lot more over at moneymetals.com/news. And if you want to get the latest news and information relating to gold and silver right in your inbox, make sure you sign up and get on our email list. Of course, you can subscribe to the Midweek Memo on your favorite podcasting platform. And when you do, you'll also be able to listen to our Market Wrap podcast every Friday, where you're going to get a quick 10-minute overview of the week in precious metals, and then a conversation between yours truly and interesting people from the world of gold and silver economics and investing. So again, thank you so much for listening to the show. Crush those like buttons, give us those thumbs up, help the show grow. Have a great rest of your week, and keep your eyes on these prices, this gold and silver market, because it is wild out there.